Let's talk about technical analysis. And I put a big warning sign there on purpose. I did that because I only want you to focus on technicals after you've analyzed the fundamentals, the valuation, and the catalyst or reason for buying or shorting a company, okay? It's very important. Don't ever start doing research with technicals, okay? Technicals are there for a couple of reasons. Number one, it makes you very unemotional about stocks, okay? And basically, if a stock breaks a certain support level, technicals will basically imply that you should get rid of that position. It makes you unemotional, okay? Next up, we've got it provides you with incredible risk management, right? So sometimes if a stock drops 20% or more, people like to sell it, right, to minimize their losses, right? And everybody's got different risk management metrics they have to adhere to at their companies. Okay. And by the way, guess what fonts those are from? Okay. My kids were part of this one. It was kind of fun. So the first one is what company? That's right, Bing. And Google. Who the heck uses Bing anyway? All right, the next one, except if you work at Microsoft, maybe you do. The next one is from what? What movie? Shrek. That's right, Mike Myers. One of my people, Canadian. All right. And this one here, basically, technicals help you identify entry and exit levels, okay? And that's, of course, from the Schrumps. Is that what you call it in Europe? Schrumps? Yeah. And the last reason is so you can live to trade another day, okay? And I know you'll never guess what font that's from, right? And so you can live to, what the hell is that? Minion? Okay, yeah, of course it's from that movie. See, when you have kids, you have to go to those movies with them and okay, it's pretty funny. So yeah, you live to trade another day. Another day. Your company or the hedge fund you work at will be alive in the long run, right? You take a knee. And some hedge funds actually, if they have a really bad month, right, if they're down 5%, they'll cut all exposure so they can take a knee so that investors don't see when they look at the historical numbers that they were down too much in 1 month. I know it sounds crazy. All right. So there's so many confusing different terms in technicals. The RSI, fill in the gap, short interest, catch a falling knife, 200-day, round numbers, whatever, overbought, illiquid. Let's go through these. This is actually a lot of fun. I love this section. All right. So the first one we're going to talk about is the 50 and 200-day moving average. And so when a stock breaks a moving average, right, and trades through that moving average by more than, say, 5% or so, computers start selling, okay? And there's nothing you can do about it. It breaks support, and it's like catching a falling knife. Nobody wants to be there. So watch for when the 50-day moving average, right, which is the red line here, breaks through the yellow line, which is the 200-day moving average, right? And again, you got to look at fundamentals, valuation, and catalysts first before you even look at this stuff. But it can help you in terms of deciding what to do from a risk management perspective with a certain stock. Okay, cool. Next up, we have got the ascending triangle, right? And this is going to sound ridiculous to all you folks that are fundamental investors, but I'm creating a menu and I'm covering every topic I think analysts care about. All right, so basically, you see the formation there. You got this chart, right, where the range is getting smaller and smaller and smaller, okay? And then what happens is the stock breaks up through the high end of that ascending triangle channel, right? And that's a bullish thing. And sometimes computers will then cover shorts and go long. When I say cover short, it means get out of the position. So you can buy a stock and then you're done with it, you sell it, right? But with a short, right, it's called covering when you get out of it. Anyway, a lot of times technicals are self-fulfilling. They matter because they do, right? I know it sounds weird. This one actually I love, right? This is a great one. So there's something called filling the gap. And there's a lot of people that believe if there's a gap in a chart that stock has to close that gap before consolidating higher, okay? And so usually what causes a gap like that is when a company releases earnings after hours, when the market's closed. So say company X, right? Say it's this chart here. Company X released earnings after the market was closed one day, and earnings were amazing. And so the stock went up huge. And so the first trade the next morning was going to be at that higher level. And so there's a gap. And there's many people, I know it sounds crazy, that believe that a stock will not resume higher until that gap is filled, okay? And look for examples in a lot of stocks you analyze as well, okay? You'll see it actually works quite a bit. All right. Next up, we have got the RSI, the Relative Strength Index. And all this one means is if everybody's buying a stock, you shouldn't. And if everybody is selling a stock, you should buy it. Okay. And at the bottom there, there's the RSI calculation, right? And it's basically just calculus, right? The rise over the run or derivatives or whatever it is, right? And so whenever the RSI, see the yellow line there, hits 80 or so, it's overbought. Too many people own the stock, right? And the stock is white, the white line up above. And whenever the RSI hits around 20 or so, that means too many people sold the stock, right? And so there's no incremental sellers. You want to be a contrarian if you want to make money, okay? So this can help you out as well a lot. But again, focus on fundamentals, catalysts, and valuation first. Cool. So the red line means overbought. The green line means oversold. There's when you want to sell a stock. There's where you want to buy it. There's you want to sell it or short it. Same thing. There's where you want to do the same thing there. So that is the RSI, the Relative Strength Index. All right, stop losses. What does that mean? Well, it means when you decide to get out of a stock, right? And say a stock goes the opposite way that you expected. Well, you got to draw a line in the sand and decide when to get out of that position, when to admit that you're wrong, right? It's cool. You're going to be wrong a lot, right? I was. So be unemotional about stocks, right? A stop loss, basically you can say, okay, if the stock breaks $10, no matter what, I'm going to cut my position in half or sell it. That sort of thing. And I always want you to think in terms of the risk reward. What's the upside potential on this stock? What's the downside? And if it's a buy idea or a long idea, the upside potential should be bigger than the downside potential. And with the upside potential, it's all based on coming up with the target price by creating models, right? And doing valuation analysis, which we'll do later in the course. We'll do a lot of that. So that's the upside, is the target price based on your model. So what's the downside? Well, a lot of times it's based on technicals, right? If it breaks the 50 and 200-day moving average, that's my downside, right? That sort of thing. Or there's a good support level here, so the stock won't go down much more than that, right? And if it does break that covenant, right, you're unemotional. You're unemotional anyway, right? There's a line in the sand you're going to get out. Okay. And stop losses also, help you to cut your losses and move on, right? It's very tough, especially if you're stubborn, right? And that's why a lot of the best investors are unemotional, right? They're like, oh, well, whatever. I made money. I lost money. And there was a guy I worked for years ago, and I remember the market was crashing one day, and I went into his office. I was like, dude, have you seen what's happening in the market? Right? And it was in August. Actually, it was August 2007, right? And that's when big technology trading companies like Renaissance Technologies and whatnot were unwinding their positions. The computers were selling everything, right? It just happened, whatever. It's hard to explain. And I remember I went into his office, and we were getting killed that day. And I said, dude, have you seen what's happening in the markets? It's awful. And this was August. And he was like, Chris, I found this Christmas paper on sale. And so I'm wrapping my kids' Christmas presents early. So, I mean, he's an incredible investor, but just unemotional when it comes to stocks. That's a true story. All right. I also want to ask yourself this. If a new piece of information ever comes up, right, regarding a stock that you own or are short, I want you to ask yourself this question. If I knew about this development way back when I put on the position, right, when I bought the stock, would I still be there? Would I still have bought it, right? And if the answer is no, then cut it. Cut it and move on to something else, okay? I hope you understand that. Let me repeat that again, a different way. So let's say you buy a stock, right? Say you buy Coca-Cola. And then a year or two later, Coca-Cola tries to buy Pepsi, which is ridiculous. It would never happen, right? Antitrust wouldn't let it go through. It just wouldn't happen. Anyway, so if Coke tried to buy Pepsi, right? And it looks like the transaction is going to go through, you could ask yourself, gosh, when I bought Coca-Cola a year ago, if I had known they were going to do a crazy acquisition, which makes no sense like this, would I still have owned the stock? And if the answer is no, you know what to do with that position. Cut it. And machine selling becomes very self-fulfilling, and this is something we're going to see a lot of in the future, right? I think in the future, you're actually going to get a lot more stocks trading together, right? And I think there's going to be less of a need for human intervention when it comes to trading, right? And so you can ask yourself this. In 5 years, are more computers going to be picking stocks or fewer? Exactly. All right, so the market is always right. Just remember that. The market is always right, not you or me. The market is. Be unemotional about stocks and you'll do very well. You have to live to trade another day. All right, trend line as a stop. Okay, so you see that beautiful chart there? The white line is the stock. right? And it doesn't violate the low end of the channel, right? See the yellow line? And then all of a sudden it does there. And if it dips down more than just a couple percent, say 5% or so, then computers will start selling. That should be your stop loss. It's self-fulfilling. It matters because it does. I know it sounds bizarre, but the market is always right. Be unemotional. Okay, other topics. Illiquid stocks own you in a down tape. Chris, what does that mean? Well, if a stock doesn't trade much every day, right, there's not that many transactions, right, and you buy a lot of the stock over time, you won't be able to get out really fast, right? It's because that stock is illiquid. And when that illiquid stock goes down, you don't own it. It basically owns you. That's just kind of a silly saying they say on Wall Street, right? And so people will sometimes say, this stock trades like water. That means it's liquid. Like Microsoft trades like water. It means there's a lot of liquidity, a lot of shares trade. But be really careful. Don't ever invest in a company that doesn't trade that much. We joke on Wall Street by saying it trades by appointment, right? Just be careful. Only invest in companies, long and short, that trade a lot, okay? So that you can get in and out if you need to. Okay, and just remember with dividends, when you're short a stock and they issue a dividend, you owe that dividend to the person that owns that stock. So let me talk a little bit more about shorting and how the logistic works. So let's say you want to short Coca-Cola, right? And so you tell your trader, and your trader will then call up different investment banks, right? He or she will call those trading floors. They'll call UBS, Goldman Sachs, whatever. And they'll ask, one of my clients wants to buy, one of my clients wants to short a lot of Coca-Cola. Do you have it available? Right? And so the Goldman Sachs or UBS trader will say, give me a second. They'll put you on hold, and then they'll call up another client of theirs. They won't tell you who, right? Sometimes it rhymes with Ridelity because that's a big client. I'm not going to tell you who Ridelity is, though. All right, so they'll call up another client and say, I have another client that wants to short a lot of Coca-Cola, and I know you own a lot. Can I borrow those shares and give it to that client? Okay, thanks. Right. So what happens is the trader on the trading floor at the investment bank was able to borrow that stock from another one of his clients, right? And give you the stock. And they'll charge you maybe 3 or 4% per year, right? To borrow that. And if the stock doesn't trade much, sometimes it'll cost you 20% to borrow over a year. I know it sounds crazy. You'll then take that stock and you will sell it on the open market. And then the stock goes down a lot. You can buy it back cheaper and then turn around and return it to Goldman Sachs trader, whoever it is, plus the fees you owe them for borrowing it, and you're done. That's it. That's how a short works. And then the Goldman Sachs trader will then return those shares directly to their client that rhymes with Ridelity. Okay? So that's how a short works. And you never want to short stocks that are crowded, meaning too many people are shorting them, right? So how do you know, Chris? Well, you can actually look in finance.yahoo.com and look at the short interest. And there's something called the short interest ratio, which is how many shares are people short, right? Somehow people calculate that on Wall Street. How many shares are people short a certain stock divided by the average daily trading volume? And if it's more than 10 days of volume, for example, don't short it because it's a crowded short. And if a little piece of less bad news comes out on that company, everybody covers their shorts and the stock goes up and you lose a lot of money. Okay. So yeah, make sure the short interest ratio is always less than 10 days. And make sure your trader finds out what is the cost to borrow that stock, right? I remember in late 2008 when I was short all the banks. I couldn't actually get a borrow on a lot of the banks, right? It was just too expensive because everyone was doing it, right? Another story though. All right, so remember that technicals are always self-fulfilling, right? Computers make them more relevant, and a lot of traders believe they're relevant, so they become relevant. I know it's bizarre. It is what it is. They're self-fulfilling.